This is today's Daily Market Comment by Mario Sachikiriakos. I'm Christina Marujos, and thank you for joining us at XM.com. Worries that the U.S. consumer is rolling over were dealt a major blow yesterday after the nation's retail sales for August overpowered some gloomy forecasts. The retail sales control group that is used in GDP calculations rose by 2.5%, more than erasing last month's decline. The news catapulted the dollar higher along with Treasury yields as traders positioned for a more constructive tone by the Fed, which might use next week's meeting to prepare the ground for dialing back its asset purchases come November. Beyond tapering signals, markets will pay close attention to the famous dot plot of interest rate projections. If 3 more FOMC officials pencil in a rate increase for 2022, that would push the median dot for that year higher, signaling a hike faster than markets currently expect. As always, what is good for the dollar and Treasury yields is negative for gold. The yellow metal sank yesterday and it amassed losses of almost 2.7% before triggering some fresh buy orders around the $1,745 region, and it subsequently rebounded a little. The fundamental outlook remains quite grim for bullion in an environment where the Fed begins to inject less liquidity into the financial system and ultimately raises rates. The best gold bucks can hope for is some cataclysmic event that reignites bullion status as a defensive hedge. There is a lot of indecision in stock markets lately. The major indices on Wall Street closed a volatile session little changed on Thursday as traders weighed a stronger U.S. consumer against worries around less central bank liquidity and risks in the Chinese property market. So far, there has been almost no spillover from the Evergrande fiasco. Still, this is a huge risk hanging over global markets because a massive hangover in a real estate sector that accounts for 28% of GDP could compound an already slowing economic data pulse, suppressing growth. As for today, there is a quad witching coming up to amplify volatility even further. This is when options and futures on stocks and indices expire, often generating some wild moves as funds and money managers recalibrate their equity exposure. This was today's Daily Market Comment here at XM.com. Have a great weekend.